When most Canadians picture retirement, they think about freedom. Freedom from work, freedom from stress, and maybe even freedom from taxes. The reality when it comes to taxes, however, is that your taxes don't retire when you do. In fact, for many Canadians, without proper planning, the biggest tax bills actually show up after age 65 and become a massive headache. It's not because you did anything wrong, it's because the CRA system is designed to quietly tax more of your income as you get older through mandatory RRIF withdrawals, OAS clawbacks, lost credits, and deemed dispositions. But there's a flip side to this story because after 65, the CRA also gives you access to some of the most powerful tax-preferred income opportunities in the entire system. And if you understand how to use them, you can build a steady tax-advantaged stream of income for life. One that doesn't affect your government benefits, doesn't push you into higher tax brackets, and helps you keep more of what you've already earned. So today, we're focused on creating tax-advantaged income. Hi, I'm Stefano Francesca, Certified Financial Planner Professional and Senior Wealth Advisor at Next Step Wealth Management with IPC Securities Corporation. If you'd like a personalized retirement strategy that helps you minimize taxes and build lasting tax-preferred income, click the link in the description to book a free call with me. The problem: most Canadians aren't structured tax efficiently in retirement. When you hit 65, your working income usually stops, but your taxable income doesn't. CPP and old age security are both taxable. Your RRIF withdrawals and pension income are fully taxable, and non-registered investments create taxable interest, dividends, and capital gains. And when all those income sources stack together, your total income can push you into a higher tax bracket, or worse, trigger the old age security clawback. Dealing with OAS clawback risk is a big deal for those hovering around that $93,000 net income threshold. And we have to seriously plan around it, otherwise we're just giving money back to the government that we didn't need to. If your income is less, then OAS clawback avoidance and all the planning surrounding that shouldn't be an issue. For those with significant income, well, Social Security programs like OAS were not designed for you. That clawback quietly takes away 15 cents of your OAS for every dollar you earn above the threshold, meaning you can lose benefits and pay more tax at the same time. In Alberta, the first $20,000 above the threshold is effectively 45.5% tax, 30.5% combined tax, and 15% clawback. The next $35,000 or so is taxed at 36 plus the 15, so that's 51%. That's a big number. Most Canadians assume this is just how retirement works, but it doesn't have to be. Because if you start shifting how your income is structured after 65, not just how much you withdraw, within reason, you can keep your government benefits and pay far less tax. Strategy number one, the TFSA, the core of tax-free income. The tax-free savings account is the single most underused retirement tool in Canada. It's estimated that about 60% of eligible Canadians have a TFSA plan, but that only 90% of open plans have been maximized. To make that worse, many people treat it like a short-term savings account, but in retirement, it could become your tax-free income engine. We did a really popular video on that some time ago, and you can click on the link here. Here's why it's so powerful. Growth inside the TFSA is completely tax-free. Withdrawals are not taxable and don't affect your OAS or tax brackets. Any amount you withdraw can be recontributed the following year, giving you permanent flexibility. Let's put this into perspective. If you and your spouse have each maxed out your TFSAs since 2009, that's $102,000 and about to be $109,000 in 2026, or $218,000 combined. If that balance grows at a modest 5%, you could withdraw about $10,000 per year, every year, tax-free. That's income you can use for travel, home upgrades, or extra spending without paying a single dollar in tax and without losing a cent of your OAS. And the best part? You can use your TFSA in combination with your RRIF withdrawals to control your overall taxable income. If one year your taxable income is high, you can draw more from your TFSA instead. If another year it's low, you can pull a bit more from your RRIF. That balance gives you full control. And that's the secret to tax-efficient retirement income. Strategy two, the age amount and pension income credits. Once you turn 65, the CRA starts offering two valuable credits that can help reduce your taxes every year, but only if your income is structured properly. Firstly, the age amount credit. This tax credit applies if you're 65 or older, but it starts to phase out once your income passes about $45,000 and disappears entirely around $105,000. So if you can keep your taxable income within that range by using your TFSA for spending or drawing strategically from your RRSP, You can preserve this credit and then save hundreds of dollars in every single tax year. Secondly, the pension income credit. You don't need a company pension to qualify for this. Once you're 65, if you convert even a small portion of your RSP to a RRIF and withdraw at least $2,000 per year, that income qualifies for the $2,000 federal pension income credit. And when combined with pension income splitting, which we'll cover next, this can create consistent, low tax income for both spouses, even without traditional pensions. These are small moves that compound over time, and they can easily save thousands of dollars across your retirement years. Strategy 3, pension income splitting, the hidden gift for couples. Here's something few retirees realize. The CRA allows couples to split up to 50% of eligible pension income, including the RRIF withdrawals, but not RSP withdrawals, with each other after age 65. It's one of the most powerful tax-saving tools available. Let's look at an example. If one spouse has $100,000 of retirement income and the other has $30,000, the higher earner can shift $35,000 of eligible income to the lower earner. Now, instead of one person reporting $100,000 and the other $30,000, both report $65,000. That small shift could fill up the lower earner's bottom tax bracket and take the higher earner out of their top tax bracket. It will protect their OAS from clawbacks and help both qualify for the $2,000 pension income credit. This strategy alone can save a couple thousands in taxes each year, all without changing their lifestyle or investments. Strategy number 4, the TFSA RRIF combo, your tax control window. Between the ages of 60 and 71, you enter your tax control window. This is when your employment income is gone, but you haven't yet been forced to take RRIF withdrawals. It's the perfect time to intentionally draw from your RSP while your tax bracket is still relatively low, and shift that money into your TFSA or non-registered investments. Here's how it works. Withdraw an appropriate strategic amount every year from your RSP during your 60s. Pay a manageable tax rate while your income is low. Reinvest the after-tax funds into your TFSA. By the time you reach 71, you'll have a smaller RRIF, which means smaller taxable minimum withdrawals, a larger TFSA, which means bigger tax-free income potential, and full control over how much taxable income you report each year. This simple strategy can save you tens of thousands of future taxes, and it's completely CRA approved. Strategy 5, permanent life insurance as a tax-free asset. For higher net worth retirees, permanent life insurance can also be part of a tax-free income strategy. When structured properly, a portion of the cash value inside the policy can grow tax-deferred and later be accessed through policy loans that don't generate taxable income. Meanwhile, the death benefit passes to your beneficiaries tax-free, helping offset future estate taxes or leaving a legacy. This isn't the right fit for everyone, but for those who've maxed out their RSPs and TFSAs, it can be an effective way to reduce future taxes and preserve wealth. Strategy number 6, ROC, return of capital. So if you set aside tax-paid capital and that asset grows, do you have to pay tax when you sell that asset? Most people say, of course you do, and they are mostly correct. But when I subsequently ask, how much tax? The answers don't come as quickly. What if I asked, do you have to pay tax on return of your own money? Now that becomes more clear because ROC, or return of capital, is not taxable. Only gains are taxable. And if that's a capital gain, only half of those are taxable and half are tax-free. Two structures come to mind that can provide tax-free or tax-preferred income, and they can work with all other sources of income to smooth or enhance your spending power. The first is corporate class investment structures. These investment structures can provide monthly income in the form of return of capital in order to create that tax-free income. The capital gain is deferred to such a time that it's more favorable, like when you've drawn down almost all of your RSPs or you've stripped all the income from your holding company. This allows your investment to grow while taking tax-free income when you need it without affecting your tax bracket. The other structure is a little more controversial. It's using your home equity through either a line of credit or a reverse mortgage. Now, I would consider this more of an option of last resort. But nevertheless, some Canadians, especially in some markets, are house rich and they think that they have no access to the wealth other than to sell it. For those that want to stay put, but may still need a little extra, using your tax-free home equity can be a viable alternative to sell it. Why this all works? Control, not complexity. The CRA's rules are detailed, but they're not unfair. They simply reward the people who plan ahead. If you understand how each income source interacts, RRIF, TFSA, CVP, OAS, interest, dividends, capital gains, and ROC, you can smooth your income protect your benefits, and keep your taxes predictable year after year. The real goal isn't to eliminate tax altogether, it's to control it. Because in retirement, control is freedom. When you know where your income is coming from and how it's taxed, you can focus on what actually matters, enjoying the life you worked so hard to build. Most Canadians don't know that after 65, they're sitting on the biggest opportunity of their financial lives to turn their savings into tax-advantaged, flexible income that lasts for decades. But the key is planning early and structuring your income the right way. If you'd like a personalized strategy that shows you how to build predictable, tax-preferred income and protect your government benefits, click the link in the description to book a discovery meeting with me. And if you found this helpful, give it a like and share it with someone who's approaching retirement. It could help them keep thousands more in their own pockets instead of sending it to the CRA. Let's take the next step.